Hi, and welcome to the Algo trading tip, successful trading in these times of market turmoil. In the past week to week and a half, we've seen high slippage in a number of markets. We've seen markets become highly correlated, and it's put a lot of stress on people who algo trade, both the trader and the strategies. So today I'm going to talk about solutions for all of these common problems. Stick around to the very end because I've got something really nice for people that they can use on their own to help you with your trading. I'm champion trader Kevin Davey, and let's get started. Okay, so this past week or week and a half or so, we've had a lot of issues with the markets, okay? A lot of people have experienced high slippage and they're wondering, hey, what can I do? Other people have had drawdowns that have just gotten too high and too out of control, especially when they're trading a number of strategies. And then other people are worried, hey, are my strategies going to survive? Are they going to make it through this? And I've heard from a lot of you. I've heard from reporters, I've heard from traders, I've heard from students, all asking these questions. And so that's what I want to cover in this video today. So we're going to talk about how to monitor and how to prevent excessive slippage. We're going to talk about how to protect yourself from drawdown, especially once it gets to excessive. And we're going to talk about how to build strategies that survive turbulence in the markets and survive high volatility. Okay, so let's get started. So if we look at slippage, let's just take the mini S&P as an example. Normally, the slippage on the S&P is one tick, and that's the bid-ask spread. So it's $12.50 per contract, and that's pretty much the norm. There's usually a lot of depth in the order book where no matter when you want to get in, the bid-ask spread is usually one tick. Well, this past week, week and a half, the slippage has jumped, and sometimes it's two ticks, sometimes it's even more. And if you enter at the wrong time, you could get caught with a lot of slippage. So here's an example of this chart, and you can see these spikes are when the slippage would jump up because the bid-ask spread is jumping up. So if you enter with a market order, you'll get more slippage than you expect. So the problem for a lot of traders, especially algo traders, is that they usually assume probably one tick slippage on all their market trades, their market order trades, or their stop loss trades, which become market orders. And if all of a sudden now they start getting two ticks, well, that can wreak havoc on the performance of a strategy, right? You could actually take a winning strategy and turn it into a loser if your wins and losses are such that you don't really have a ton of room for extra slippage. Okay, so how can you solve this problem of having the slippage be too high? Well, first, you really got to monitor it, right? You got to make sure that whatever market you're trading, that the slippage isn't out of control. So I've created a simple indicator you can put on a chart. It just monitors the bid-ask spread, and what it will do is it will print out in dollars per contract what the current slippage is. And so if you see a lot of spikes like you do in the chart below, then you know that you're getting some higher slippage times. And so maybe you want to be careful about trading during those times. Another solution is just trade during the liquid times. Don't trade overnight. If you have an overnight system, well, maybe you just don't trade it for a while. Trade when other people are going to be trading, and that should at least minimize the slippage. You can still get two ticks or more slippage during these times, but chances are it's probably going to be lower when a lot of other people are participating. So that's a good solution. And then, of course, if you know your strategy can't handle large slippage and that's what you're seeing a lot of the times, just turn your strategy off. There's no harm in doing that. It's much better to live another day than to have excessive slippage and cause you to lose more money. So that's the first problem and 3 solutions for it with slippage. Now, the second one is looking at drawdown and correlated markets. So the past week and a half, we've had a lot of markets that all of a sudden have all trended in one direction or another. So for example, the mini S&P has had a $27,000 top to bottom move per contract. The gold has had 13,000. Treasury bonds have had 12,000. Even at looking at currencies, they've had some extended moves that have been pretty big. And then a lot of times you don't see this, but even some of the soft markets, so cocoa, cotton, they've had extended moves. Crude oil's also had a big move of $11,000. Now you'll see crude oil and energies do that a lot, but a lot of times not with the soft. So in this past week, you've seen a lot of markets just move directionally in one direction or another. So if you have algo strategies that are trading different methods, but if they're all trend following and you just happen to be on the wrong side of the trend, you could have really gotten nailed with some horrendous drawdowns. It's not too often that the markets do this sort of thing. It's just unusual. And if your strategies were lined up incorrectly, it might have cost you quite a bit of money. So what can you do about that if this was the case for you? Well, the first thing is to take a look at the correlation of your strategies and the markets you're trading and see, hey, is what happened really a fluke? Or maybe it was a certain strategy or a certain market sector that got you into trouble. The key is you got to do some analysis to this. And then you got to look at the markets. And this might take even more investigation, but was this foreseeable? Has this ever happened before where you've had all these markets trending like this? Well, you'd have to look back through your history and your back test and see if this kind of thing ever happened before. Probably for a lot of you, it didn't, because this is kind of an unusual thing, but that's something you want to investigate a little bit and see if it happened. And obviously, one solution when you start to see this sort of thing and start to see your account hit a big drawdown, one you did not expect, hopefully you've done some simulations to say, oh, well, I have a 5% chance of a certain drawdown. And if you see something out of the ordinary, you just hit that emergency button, right? You hit that kill switch and you stop trading for a little while until things kind of get back to normal. Don't let your strategies just keep going if they're riding you into your account into the ground. That's not a good approach. People always think, well, hey, high volatility, I got to make money, but be focused on the downside. And if you start experiencing drawdowns you didn't expect, well, maybe just take a break for a little bit. That's a good solution. Okay, so those are 2 of the issues. Now, the third issue, a lot of people have been wondering, well, will my strategies survive? Will my algo strategies work because of the volatility that's there? So I'm going to talk a little bit about how to build strategies to survive some of this high volatility times. And you can see it on these charts with the mini S&P and gold, how volatility's just exploded in the past week and a half. It's gone to levels hasn't really been in it in a while. Now, historically, I'm sure there's times where you could go back and look and find even higher volatility, but you might ask yourself, do I really want to be trading during these times? There's 2 schools of thought. One is, hey, high volatility is when you make money. But the other thing is, well, high volatility is also when you can lose money. And what a lot of professional traders do is they focus more not on making money, but on not losing money. So I'll say that again. Professionals focus on not losing money. That's where their focus is. Making money, okay, yeah, everybody wants to do it, but not getting wiped out is probably more important. So when the volatility gets like this, you've really got to be aware, because your strategies might not be built for this type of volatility. Depending how long you ran your back test, maybe you never tested volatility like we saw in the past week and a half. So if you didn't, maybe your strategies will work, maybe they won't, maybe they'll just get whipsawed and in and out with little, relatively small stops. You don't know. So you've got to be careful. So one thing to kind of look at is know what your strategy can handle, and then you got to kind of accommodate it. So a couple solutions. One is if the emotions are getting to you, and for a lot of people they are. This past week was very stressful. Hey, just turn them off. I've mentioned that a couple times already, but that's not the worst thing you can do. The worst thing you can do is to have a nervous breakdown over this, to have a heart attack over it, and to let things go and your account drives into the ground. In the long run, your mental health is much more important than a couple trading days. The markets will always be here, but if your account dwindles too low, you're not going to be here. And if mentally you freak out, you're not going to be there. So remember, this is a good solution. And then the second one, and probably the better one for a lot of you algo traders, is to add logic to your strategy just to prevent trading from entries or exits during high times of volatility. So I'll give you an example of this. Here's a strategy. It's just a simple one bar momentum, and I've applied it to the S&P. So, if the close today is greater than the close yesterday, then sell short, and vice versa to buy. So this is a simple strategy. I'm not saying this is a good one, but look at the past 3 months. In January, it made money. February, it lost a lot. And in the first 3 days or 4 days of March, it's made a lot back. So it's been up and down and up. That's stressful, right? Well, let's just say you put in a switch that said, hey, I only want to trade when the volatility is not extreme, okay? So here's some code. This is TradeStation format, but basically what I'm doing is I'm looking at the true range of a bar and comparing it to the last 5 bars of true range, or the average true range. And if it's extreme, I just turn everything off. So I don't take new entries and I get out of trades. Now, obviously you could play a lot of different scenarios with this. Well, maybe you just exit trades, maybe you just exit losing trades. You could use different things in the average true range. This is just an example of what you could do. But when I do this, it gets you out of a lot of trading. And so you can see January and February were a lot less stressful. And March, it didn't make any trades. Now you could say, well, hey, the other one overall made money. Sure. This one lost money. But you also didn't have a $20,000 loss in February with this method. This one you still lost. You lost $7,000, but less than half. So you have to ask yourself, is that worth it? And the key with this is you put this code in before you test a strategy and then just run it like that. And then if the strategy works, you'll have that safeguard in place that it will turn off strategies with high volatility. And again, the goal isn't necessarily to maximize your profit. It might be just to save your sanity by keeping the up and down swings low and to prevent some losses. And finally, the key again is to properly test it. Just don't go implement it and hope it works. You want to back test it and back test it correctly, which unfortunately most people don't do. Okay, so this past week, high slippage, out of control drawdowns, and strategies that may or may not been able to handle high volatility. I've given you 3 solutions to help with the slippage, 3 solutions to help with the drawdown, and 2 solutions to help with the high volatility. If you subscribe already to my newsletter, you already have the link to download all the code and the workspaces and TradeStation format for this. If you don't currently subscribe to my newsletter, just click in the link below and you'll be able to sign up and get all that code, and then you can go and modify it and make it fit your needs. Okay, so that kind of wraps it up. If you liked this video, please subscribe to my YouTube channel. That'll keep me making videos like this. And of course, if you really liked it or have questions, just leave a comment. I'll reply to all comments and we can have a conversation of things you might do differently or things I didn't think of. And if you really want to help other traders and you think this video is one way to do it, post this on trading forums and other places where you see traders, on your Facebook page, on your Twitter timeline. Share this. Let's make this go viral if you think this is important information. I certainly do, and that's why I took the time to make this video. This last week and a half has been really, really stressful for a lot of people, and I think these solutions can help a lot of people, especially the next time this sort of event happens, because I'll tell you what, it'll be different, but it's going to happen again because these kind of things happen. So again, thanks for watching. I'm Kevin Davey.